All right, this is just a short video that is intended to update my presentation video I gave as a roundtable at Aeromere on April 29th, 2020. The subject of that presentation was my trading course that is being offered at forumofinancial.com called the Automated Volatility Trading Course. It was about my journey as a trader and how I came to build that course. And the presentation was called, as you see here, Volatility Profit Spikes. So, like I said, this short video is just intended to provide some updates to that presentation. So let's go to the disclosures here. This is for educational purposes only, so keep that in mind as we go through here. Okay, since my course has been for sale, there have just been a few things that have come to my attention and have prompted me to record this update to my presentation as a way of providing important notifications or disclosures regarding certain aspects of these systems. And I believe that in the spirit of fairness, it's important to make sure anyone who sees that presentation, and of course, who may be considering purchasing the course, is aware of these things that have come to my attention to allow a more informed choice when deciding whether or not to purchase the course, and of course, whether or not to employ these systems in a portfolio. So these are updates, notifications, or disclosures, and they are intended to help potential purchasers make a more informed decision. So if you've seen the Aeromere presentation or the presentation video at formafinancial.com, you've most likely seen this equity curve. And if not, then it's even more important that we go through this prior to your viewing of the presentation videos. So this is the equity curve that my particular strategy that I teach in the course creates when back tested back to about late 2014, early 2015 in long volatility, which is when I started trading long volatility in the live markets. And this curve ends, of course, right before the big volatility event and market crash of 2020. Back in 2014, 2015, and up until 2018, I wasn't yet trading the particular strategy in long volatility that I teach in the course because I hadn't developed it yet. But I was trading long and short volatility through the years from about late 2014, early 2015, kind of flipping from long to short, short to long at equal risk allocations, and then sometimes trading them as separate systems. Sometimes I was long and short at the same time in different volatility instruments, and I was profitable for several years in these systems. Okay. And this curve, by the way, is just going long UVXY. This is just long volatility at $60,000 a trade with nothing else added to it. And the important thing to understand about this equity curve, which is one of the reasons I'm making these updates, is that the upward drift back here from prior to 2018, right about the cutoffs, right about here, and then prior to 2018 there. It is very it basically we are unable to verify the back testing results here. And that is because historical UVXY prices provided by TradeStation, which is the broker used and the platform it's taught in the course, historical prices in UVXY prior to 2018, from about late 2017 and before, going back in time, start to become way, way too high due to price splits in the instrument. So my particular strategy, which takes advantage of the behavior of volatility by taking profits or scaling out during volatility spikes, was not actually able to scale out prior to 2018 because prices were just too high. So it's basically, it was basically, instead of scaling out like it's doing from about 2018 and on, prior to 2018, it was just maybe getting long one share and then getting out, getting long two shares, getting out. So it wasn't actually scaling out. And since my strategy was not doing the same thing prior to 2018 that it's been doing since 2018, these results back here just simply cannot be verified or confirmed in backtesting. Like I said, my strategy, like I said, just wasn't buying enough shares to scale out. So it's important to understand that whenever I reference this equity curve or actually show it in the presentation video as well as in the course and refer to it as upward drifting as a standalone long volatility strategy, that upward drift can only be verified from 2018 and after and not before. Nevertheless, the results since 2018 can be confirmed in the live markets because I was trading it, and the backtesting picture is more accurate because historical prices start to get closer to reality. They come way down to about where they were, and I actually traded this in the live markets, and I can attest to this performance. So that's important to know. This upward drift right here from 2018 can be verified. And then, of course, this happens, okay? And this is possibly the most important thing about this long volatility system anyway. Whether it's got an upward drifting curve over time or not, it's there to do this when the time comes, this big spike, okay? And so, since historical performance can't be verified for sure prior to 2018, using my specific method, scaling out calculations, let's look at a system that employs a scaling out method that is similar, a bit different, but similar than mine, that can provide a more, possibly a more accurate backtesting picture because of the difference in the way the scaling out is calculated, as well as the fact that a more risk allocation is applied to it per trade to deal with those crazy high historical UVXY prices. Okay, so applying this different strategy that allows for a method of scaling out, albeit a slightly different method than my particular strategy that's taught in the course, then adding more risk allocation to each trade back through time to deal with those high UVXY prices provided by TradeStation and based on price splits, you can see this kind of historical performance picture. When it comes to the angle of the equity curve, this is obviously more flat than upward drifting. This equity curve was provided to me by a purchaser of the course who's been backtesting and working with volatility for many years and was able to apply a risk allocation of $10 million per trade in TradeStation and apply a similar scaling out strategy all the way back to about 2013. It's not exactly the same, but it is similar. So first, there's more risk allocation being applied, as I said, to each trade to deal with the high prices in UVXY. And second, it was actually scaling out back here prior to 2018 while mine was not. I appreciate the work this individual has put into this, and I felt that this should, in all fairness, be disclosed since performance with my particular system just could not be verified prior to 2018 since it was basically doing a different thing prior to 2018 than it was doing after 2018. With that said, my particular system will nevertheless be taught in the course since the upward drift can be verified. Since 2018, I believe in trading things that work until they don't work, but the code provided by the purchaser will be provided to any new purchasers of the course in case they want to test and optimize that and use that and actually see and use that system instead. So if you purchase the course, you would have the ability, you would have access to the different codes so that you could test them and look at them for yourself and decide for yourself which one would be better to simulate and potentially run. I believe that is the fair thing to do. And it's important to understand too that even if a long volatility system like this has a flatter curve on its own, it can still allow a portfolio to build income even through bull markets when paired with other strategies. That's very, very important. Other strategies like short volatility, which I teach in this course, or going long SPY, going long the markets, or market neutral positive theta options trades, things like that. Protects the portfolio. It's in there to do that, and potentially makes huge outsized profits during market crashes, which is what it did for me in this last market crash. You see that's the big spike there. And this leads us to the next important disclosure that I believe should be made. Okay, and the second update or notification or disclosure has to do with the kind of drawdown that is possible in these kinds of long volatility systems. I believe this is another point that should be discussed in order to help the viewer of the presentation video make a more informed choice as far as whether or not to purchase the course and certainly whether to employ these kinds of systems in his or her portfolio. This is an equity curve in VXX going long using a similar scaling out system to the one that I teach in the course that is used in UVXY. It's not exactly the same because VXX does typically respond better to fewer scale outs than UVXY does. However, since I was able to access more historical, more accurate historical VXX prices. Let me make sure I say that correctly. At least on this time frame, 45 minutes, in an earlier version of TradeStation, it can be argued that these results provide a realistic backtesting picture in VXX going all the way back to about 2010. In other words, the historical prices in VXX not being unrealistically high, like they are in UVXY, allowed for actual scaling out all the way back to then. You can see the VXX prices back here are not in the millions and hundreds of thousands like they are in UVXY, and so through time they're much lower, much closer to reality, and that allows for more realistic back testing. If you go back to the UVXY prices and you look those up, you'll see that the way they're provided due again to price splits in the instrument. You'll see in the millions going back to 2013, hundreds of thousands, so very, very high going through time there. And so that's important to see. So we'll go back to the performance graph in VXX here. I believe it's important to see this when deciding whether or not to employ these systems, because a drawdown like this, which starts in about 2011 and even goes through into 2014, can obviously be very difficult to endure. And because the systems are similar, it's not exactly the same, but similar, it's possible that UVXY may have experienced the same kind of drawdown at this time to some degree. Just as a note, it's important to mention VXX is not a leveraged instrument and UVXY is, so performances between the two may differ because of that as well. And also, like I said, the number of scale outs is different for each instrument in these systems, but so they're just a little bit different. This being shown and disclosed does lead me to the next important point, that a portfolio can still be protected and income can still be built over time in bull markets in spite of such a drawdown. So this is not a deal breaker, and I'll show that. Pairing other strategies with these long volatility systems, like I've said before, is a major part of this course, and it's important to make the point that when pairing the right strategies, bullish strategies in stocks, short volatility, like I said before, strategies in indexes, strategies in options, with these systems, these long volatility systems, even with this kind of a drawdown, can provide a positive result over time. I showed that in the presentation video at formafinancial.com, and I'll show that again here. So keep this drawdown in mind as we go to the next visual. Okay, so this is a comparison between two equity curves. The first one is a passive investing strategy in VOO, just going long VOO, which is an index ETF that tracks the S&P 500. And in this particular strategy, you're starting at $50,000 at the beginning of 2011, okay? And then whatever you make, you add and at the beginning of the next year and then go through time like that. So it's kind of a compounding chart here. And then on the right, you take a long VXX strategy, the same strategy that yielded that equity curve I just showed, and you take $60,000 per trade in long VXX, and you add it to VOO. So this equity curve on the right is both of these combined. And long VXX, of course, is added to provide protection for your passive investment strategy here. And so you can see as you start out at the end of 2011 here, in the long VOO strategy, you're up just a little bit, probably just dividends. But at the end of 2011, if you've added long VXX at 60,000 a trade, you've made a big jump because of that crash in 2011. But then, of course, the drawdown in long VXX creates this flat to down angle here. And so that is what that drawdown is doing to the strategy. It's not destroying it, obviously, but it is creating a 2-year sort of flattish to down angle here. Then the drawdown, remember, does extend into 2014, and even so, you see at the end of 2014, these together, you do end up making money through this, and then you continue to build income with these together. It's not the same angle, of course, through here, but right here in 2018, and then, of course, in 2020, this is why you've got long VXX protecting your portfolio. And this is really the main concept of my course, is that you put this into your portfolio, long volatility, and then when this kind of thing happens, it can lift it up and angle it up, and you're making money instead of losing money. And then, of course, this is the big one, because during a black swan type event where you get a huge spike in volatility and a huge market sell-off, and you lose a lot of money in a passive investment portfolio or in whatever you're trading, if it depends on more normal type market environments, you lose this money. But if you add a long volatility element, then this can really help you spring up to another level in your equity. And then if we continue to climb from here, you're ready to do that. And now let's look at actually changing the risk allocation, and I'll show you what that does to the chart on the right here. So if you decide now, I've flipped to another chart. It looks very similar, but I have flipped to another chart here. This is less risk allocation in VXX now, long VXX. Instead of 60,000, it's 30,000 per trade. The same risk that you're putting in VOO, but less in long VXX now. And you can see now it's still protecting your portfolio, but now that you have less risk and long volatility, you're actually making money instead of that flat to down equity curve from 2011 and through 2012 through 2013. And you're actually through this bull market, you're just continuing to build that income. So it does, and then you still get that nice protection during this black swan event, even though you've added less risk in your hedge. Okay, so this shows the kind of power that this portfolio protection can give you, that long VXX and or long UVXY can give you in your portfolio. And I wanted to show this. These visuals show that even a passive investing strategy can work well with long volatility taught in this course, depending, of course, on the risk allocation used. And that income can still be built while the long volatility strategy sits in your portfolio and waits to protect you, and indeed to make lots of money for you in a market crash. And I believe, although it's important to understand that these systems do draw down, and a large extended drawdown is possible, it's also important to see these drawdowns won't necessarily be deal breakers. Anyone who purchases this course and considers running these systems should definitely simulate them first to determine whether or not they fit their personalities before taking them into the live markets. Play around with risk allocation, test them, take a look at them. You have to ask yourself, when considering trading this particular kind of hedging system, can you withstand a drawdown like this, even if you're trading other things with edge during this period that may be lifting up that drawdown? Or certainly a passive investment portfolio that's making money and actually kind of counteracting this. So it's an important question, something that must be considered before deciding whether or not to purchase the course and certainly employ these strategies. So last of all, if you do decide to purchase the course, I highly recommend watching the May 12th, 2020 group mentoring video in the archives after watching the entire course, because these items are dealt with along with some participation by mentoring group members in that session. Questions are asked, there's interaction, there's conversation. It's really helpful. I think it will provide a clearer idea of why this update, these notifications were necessary, and help you make a more well-informed decision on how to go forward with these long volatility systems for yourself. And last of all, I just want to say that I put this course together because I wanted to offer something to newer traders and those still trying to become profitable, as well as experienced traders and even passive investors, that could provide portfolio protection in deeper market corrections and even outsized profits during market crashes, as well as a hedge that won't prevent income building during bull markets, but also something that can be used kind of as a springboard. Short volatility was my first successful system and gave me the confidence to stay in the markets and eventually build a profitable trading career. And I hope these concepts can provide this kind of value for you. It also can give you another skill in your set, since it teaches the basics of automating on the TradeStation platform. So feel free to email me at preston@formafinancial.com if you have any questions. I try to get back to everybody as soon as possible. And you can use the link https://formafinancial.com/Arrowmere to access and purchase, access the video and purchase the course if that's what you would like to do. Thank you for listening, and I hope to see you in mentoring.